All right, all right, all right. How's everybody doing this afternoon? Glad to have you. We had a wonderful class last night at the university, and so today is the lab for that class. And so what we're going to do is we're going to practice what we preach. We're going to go through, and hopefully you guys got the email that I sent to you that talks specifically about what we learned last night in class. So let's review that just real quick, and then we'll go through and we'll start doing some applied math. All right, we'll apply what we learned last night in class. So we learned to count, measure, set up, trigger, and follow through, right? That's our 5 mantras for trading. Every time you look at a chart, that's what I want you to think in your head. Count, measure, set up, trigger, and follow through. What am I going to count? I'm going to count the waves of the market. Markets have a tendency to move through waves, 2 steps forward, 1 step back, 2 steps forward, 1 step back. All right. That's just called a traditional wave, right? Or a traditional trend. Higher highs and higher lows, lower highs and lower lows. So higher highs and higher lows makes an uptrend, lower highs and lower lows makes a downtrend. So we're going to look for those patterns in the market. So that's what we're going to count. How many times did the market make one of those little patterns? Now, traditionally speaking, Elliott Wave theory tells us that markets have a tendency, once they start to run like that, to do 3 of those drives. So we have count, we have measure. Measure, we're going to use a Fibonacci ruler. Now, don't get all scared by the name Fibonacci. That's just the name of the guy that came up with the idea. So the Fibonacci ruler is just a ruler. All we're going to do is just measure those moves, okay? Those A, B, C, D patterns, those 2 steps forward, 1 step back, 2 steps forward, 1 step back. We just want to know how big they are, because the first leg is oftentimes an indication of how big the second leg will be. So if you got A to B, you got C to D, and then you got D or C, let's see, A to B, and then B to C, and then C to D, right? So if A to B was this long, well, we would expect C to D to be that long too. That's all we're doing. It's just kind of a predictive model of if the volatility caused the market to move this far on the first leg, maybe it will do the same on the second leg. And it's pretty good, makes a pretty good guess. All right. So it helps us out. And that's all we're doing with the measuring tool. And then, of course, it has a retracement level. So how far back, once it runs up, how far back does it come against the previous run? That's all we're doing with the ruler. Okay, that's Fibonacci. Very simple stuff. We're going to go through and do a bunch of that here, show you how to use it. We don't have to do the math, of course. We've got computers to do all that. All we have to do is just understand the concept. Markets have a tendency to rally and pull back, rally and pull back. Well, how far do they rally and how far do they pull back? Let's measure that. That's all we're doing. All right, very simple stuff. So we have count and measure. We have setup. What's the setup? Well, a setup is one of those little recurring price patterns that we talked about, right? Where we draw areas of support across the bottom and resistance across the top. So we draw our little trend lines. So that sets up what we call a setup, right? And then we have a trigger. What is a trigger? Well, a trigger is a breaking of one of those trend lines. So as long as the market's staying conformed inside of those trend lines, we don't get in. But when it breaks those trend lines, well, that's a trigger for us to get into the market. So we have technical analysis, which gives us the setups and the triggers for entry to a longer term trend, which is driven by the fundamentals, right? The fundamentals being, news events, something like the Fed Reserve giving us information about raising or lowering interest rates, maybe legislation that's coming along. If we're in the grains or meats or soybeans or things like that, it could be weather, that could be weather related. But there's whatever the fundamental driving factor is. Earnings could come out in a nice stock, and we got big earnings. That would be a fundamental reason why a market might rise in price. But we need to have a setup and a trigger, a point where we say, oh, okay, now's the time to get into this market, so we can start to buy. So that's what the fundamentals give us, the long-term trends, and the technicals, they give us the setups and the triggers for the short-term trends and for the entry into those fundamental runs. So we need to use them both together. All right, we need to use them together. And then we have the follow through. So count, measure, setup, trigger, and follow through. The follow through is what tools do we use to get in and out. Now, tools meaning orders. All right, so we have lots of different orders. We have stop orders, we have open stops, we have closed stops, we have market orders, and we have limit orders. And we can use open limits and closed limits. All right, so there's lots of different ways to use these different tools that give us the ability to get into the market and take advantage of it and set up strategies. All right, so remember, trading is always like playing football. All right, I have my set of strategies, they have their set of strategies, and we're going to run our strategies against their set of strategies, and we're going to try and gain yardage on them, and they're going to try and knock us back. All right, it's like a game, and you're playing a game against the other players on the other side. Oh, thank you very much. My dear sweet wife brought me some tea. Okay. All right. So I don't lose my voice again. All right. So we're going to play a game. All right. And so that's what the manual is all about. So this is what we call the Fibonacci manual, right? The Fibonacci effect. That's why, the Fibonacci effect, how we use Fibonacci to help us make our trading decisions. So that's just measuring the market. So we want to use measuring tools to help us decide how long we think we can run the ball, how far we think we're going to have to get knocked back behind the line of scrimmage, how much we might have to risk or lose to get the ball moving downfield. And so that's what this is. The market playbook of strategies. Okay. So all of you who are in the class at the university, you have this as part of the class. And as you scroll down, you're going to come into the different sections. All right. Now I'll scroll down a little bit faster here. We're going to get to the first section. The first section is our Elliott Wave section, right? And so this is where we talk about the different waves, the wave patterns. All right. And as we come down here, there's lots of examples of the different wave patterns. And so you're going to read chapter 1 of the book, and you're going to understand and learn about Elliott wave patterns, which are really nothing more than two overlapping A, B, C, D patterns. So this little pattern right here, you see A, B, C, D, and then you see A, B, C, D. It's just two A, B, C, D patterns overlapped. So that's an Elliott wave, all right? So we look for 3 drives. That would be drive 1, drive 2, drive 3. So we kind of count it like this. So big Elliott waves are made up of little Elliott waves. So that's what this pattern here is. So we're going to come in here and we're going to see little X, 1, 2, 3, 4, 5, A, B, C. X, 1, 2, 3, 4, 5, A, B, C. But over on a longer term basis, you have X, 1, 2, 3, 4, 5, A, B, C. So this is just a market probability statement. All right. It's not saying that markets do it every single time, but if you look back in history, you're going to find these patterns. It's just another recurring price pattern, just like a triangle, a wedge, head and shoulders, anything else. It's just a recurring price pattern that happens a lot. Doesn't mean it happens every time, and not every markets do it. It has to do with how much participation we're getting from not only retail traders, but also from big, large hedge funds and brokerage firms. All right. Those are the guys, the big banks, and those guys are the ones who are driving these markets, and they trade like this. Okay. So this is kind of the little key, the secret to your success is being able to understand that markets move through these waves. Now, I've gone through and I've labeled these in a very special way, a little bit different than what you might find if you go buy a Fibonacci book or an Elliott Wave book. There's a book out there on Amazon you can get. It's about that thick on Elliott Waves. And if you want to get it and really dive into Elliott Wave big time, you can. But I oftentimes tell students that if you get that book, just tear the first chapter out and throw the rest away. Because the first chapter, all it does is really tell you the ABCDs, just kind of like what I've highlighted here in our Fibonacci effects book. And then the rest of it really is just a manual on telling you why they didn't work. All right. All the different caveats on why the little ABC patterns didn't work. Well, they didn't work. You don't throw the so it's just a whole bunch of why it didn't work. So just realize it's just a recurring pattern and it's not perfect. It works a lot, but not all the time. But it works enough that it's something that we can hang our hat on and we can use as a foundation of our trading structure. All right. And so when we see these patterns, we can start to anticipate that they're going to go through these patterns. If the pattern's not present, well, you don't need a book to tell you it's not present. You can look at the market and say, well, it's not going through an Elliott wave. So you can just kind of ignore the rest of that book, in my opinion. But it's really cool. It's about that thick of all the reasons why the Elliott wave didn't work. And so then what we do is we come through, and I've labeled these very simple. Try to keep it easy for us, all right? So we have 3 drives, so I just call them the A drive, the B drive, and the C drive. And then since markets are fractal, and the drives are made up of smaller Elliott waves, I give each little Elliott wave a number. So this is the A drive, so we call this the A1. This is the A2, and this is the A3. All right. So inside of the first A drive, you have 3 drives, little drives inside of the bigger drives. It's called fractal. All right. And so that's what we have. So then we call this little ABC retracement. Then we have the B drives. We have B1, B2, and B3. And then we have C1, C2, and C3. Very simple, easy stuff. All right. I'm trying to keep it as simple as possible for you to understand how markets move through price and time. Now, do they do this perfectly every time? No, but it's surprising how often they do. And you'll be surprised we can go and find this pattern all over the place in the stock market. All right. And when we find this pattern, we can trade it. If it's not there, for us, we probably go look at a different market. Well, our pattern isn't there. So I guess we can't trade that one. We don't really know how to predict what a market's going to do if it's not going through our pattern. All right. Other people can trade those, let them go trade those. That's what they do. For us, we want to go along with the big hedge funds and banks and the big institutions and kind of play and do what they do, which is these Elliott Wave patterns. All right. And it's called the accumulation distribution model. And that's a Wyckoff theory. And so when you add these all together and you meld them together, you get this count, measure, setup, trigger, follow through trading strategy. Okay. So there's tools that can help us. And I'm going to go through, and this is just the manual, just kind of coming down through the manual and showing you how a lot of this stuff works. So everything's documented in the manual. For those of you guys who are not in the class, you can go get this online at pitnews.com. Just go to pitnews.com and there's a store where you can buy the digital version, but you can also get the printed version. If you like paper, printed version, it comes in a printed version. It's like 230 pages or 220 pages. It's full color, and you can get it off at Amazon for a little under $50. All right. It's a great big 8.5 by 11. It's not a book like you're going to read it. Well, I guess you could. I was going to say you're not going to lay in bed and read it for entertainment, but it will definitely put you to sleep. So if you want to read it at night, go ahead and do that. But it's more of a workbook. It's soft-sided, so you can lay it out on your desk and you can say, okay, I'm looking at this or I'm looking at that. What patterns am I trying to find? So you can use it as a workbook when you're trading. And so that's what it's designed as. And we go through pretty detailed, where to buy, where the setups and where all the triggers are and how they all work one with the other. And I show you a lot of examples in real market trading so you can see how to get into these markets. So you can see here's an example of a 3-drive pattern. You got drive 1, drive 2, drive 3. This is the A drive, the B drive, and the C drive. And you can see the little pullbacks or the counter trends and where we use our technical analysis, our drawing of trend lines to help us find setups and triggers and entry points for getting into these A, B, C patterns. All right. So that's really what it's all based around. And these little trigger points in here, this is where our Fibonacci and Elliott Wave come into play. This is I want to come down here. I want to get to the point where we have the probabilities. Where's the probability picture? It's in here. Where do we get to the probabilities? Right in here. Here we go. So here's the window that gives you the probabilities. All right. So when we trade, it's all about probabilities. And so this has been designed. I put this in here so that what you could do is you could print this one page off and hang it on your wall. And so it ends up being probabilities. All right. So again, this is just a structure. Now remember, it's like going to the blackjack table and then, in Las Vegas, they give you little cards that tell you what the probabilities are of a hand of blackjack being a good hand or a bad hand. Well, we do the same thing in the stock market. We want to have a little probability statement that tells us, hey, if I'm at an A1 or an A2 or an A3, how does that compare to a C1, a C2, or a C3? What's the probabilities of a C1 paying off versus a B1 paying off versus an A1 paying off? Is A1 better than B1? Is B1 better than C1? What are the probabilities there? Now, as a market starts to run, these probabilities, the higher it gets up, the probability of it continuing starts to get lower and lower and lower, right? Makes sense. Generally, markets go up and then they turn around and come down, and then they go up and then they turn around and come down. So the higher you get in that probability, the lower the probability is that it's going to continue higher. That's why we don't want to buy high and try and sell higher. That's a really hard strategy. We want to buy low and sell high. Doesn't mean you can't buy high and sell higher. You can. It's just a really hard strategy. So you don't want to be buying B3s because the probability of that paying off is really low in comparison to something like a B1. So you play the probabilities, and that's really all we're doing. We're trying to get good probabilities, put the probabilities in our favor. It's why I always tell you that when we're trading, we're not gambling. We're not going down to Vegas and rolling the dice, and we're not spinning the wheel, and we're not playing the cards. We're not pulling the handle, because those odds are always stacked against you every single time you pull the handle. You think, well, if I pull the handle enough, eventually the odds will get in my favor and I will win. That's not true. That's called the gambler's fallacy. Every time you spin the wheel, you have the new set of odds start again over every single time, and the odds are always stacked against you. But that doesn't have to be the case in the stock market. The stock market is not a gambling casino. The stock market is more like, in my opinion, what I think of the stock market as a fairway in a fair, like a fair. You go down to the fair, all right, the fairgrounds, and they have these games that you can go up to the tent. You can throw darts, or you can go and you can throw a basketball, into a hoop, but or you can throw a baseball into an apple basket, and the odds are stacked against you. Yes, they've kind of jiggered the game so that it's hard to win, but it doesn't mean you can't win. You still can. You throw a baseball at a little stuffed animal, a little stuffed bear or something, and it's got lots of hair around it, so it makes it look big, but in reality, it's just a little tiny thing, and you have to hit it directly on. But it doesn't mean you can't get good at it. All right. So the point being that it's more like a carnival game than it is a casino. So you can become very good at throwing a baseball and hitting those little guys, and you can win. You can put the odds in your favor by practicing and by knowing the odds of what you're doing. Okay, you can go to a fairground, or you can go down to the fairgrounds and go up to the tent, and you can throw the basketball. Now the hoop's going to be a little bit smaller, it's going to be a little bit further away, and it's going to be a little higher up. All right. And the basketball you're throwing is going to weigh different than the one you're used to when you're playing in high school or whatever. And it doesn't bounce as good, but when you throw it, it's not going to act the same. And that's how they put the odds in their favor. But it doesn't mean you can't get used to that. And it doesn't mean that you can't throw the ball and eventually start making a whole bunch of baskets and walk home with the big panda bear. All right. So the stock market is more like a carnival game than it is a casino, because you can put the odds in your favor and you can get good at this. All right. So it just takes practice, because the markets can only do three things. They can go up, then go down, then go sideways. And all we have to do is be able to identify when that might happen. And we never know for sure when it's going to happen. We can just look for the setups, the triggers, and then we do the follow through. We put in our orders, and if it doesn't work, we get out. And if it does work, we stay in. All right. So that's how you make money in the stock market. You just got to put the odds in your favor and realize what you're doing is you're playing a carnival game. And you can lose money doing this, just like when you go and you give the money in your ticket to play the carnival game. You throw the basketball and you miss all three times. Well, you lost your money. You didn't win your bear. You might have, they might give you a plastic frog. Well, that's your consolation prize. That's all you get. You didn't win the big panda, or you might even lost your money. You didn't even get the plastic frog. Depends on how good you are. Maybe you got one basket, but not, they give you a plastic frog and that's all you got. All right. So the better you get at doing this, the bigger your reward. And so that's what this is all about. It's trying to put the odds in your favor of being able to teach you how this market works so that you can take advantage of the market and learn how to get good at this. And, if it's like, oh, this is too hard, Lan, well, don't do it then. Because there's guys out here that have been doing this for 30, 40 years, like myself, who are really good at it. All right. And we're just going to take your money. So I would recommend that because if for every winner, there's a loser. And if I win all the time, I'm taking somebody else's money. If you're losing all the time, well, you're giving money to somebody else. That should give you hope, meaning that if you're losing, that means somebody else got your money. All you have to do is do what they did, and then you would have got their money, right? Or got the money of somebody else. So the name of the game, I've told people that in the class. So I've said, this is for every winner, there's a loser. And I've had people drop out and say, well, I'm not going to trade the stock market because I feel bad taking people's money. I was like, okay, don't do it then. So don't do it. If that's something that you're not, you can't deal with, that some people are going to take your money when you lose and some people you're going to take their money when they lose, then don't come and play this game, because it's a carnival game. And that's really what we're doing. We're taking other people's money. It's really what we're doing. All right. So we're going to come in here and take a look at the markets, and we're going to draw some patterns, and we're going to look at what I want to look at is the Wyckoff pattern that we're looking at, and the Wyckoff, and identify some Elliott waves and show you how to use the Fibonacci ruler. So we're really just going to go through and look at some markets. And this is Apple. We pulled this one up last night in class, and I want to kind of show you how this is playing out. So the first thing I want to do is I just want to draw some trend lines. That's all we do. We're going to come in here. We got this really fancy piece of software that we can use to help us do all of our technical analysis on, and we can analyze markets. You need a really cool tool like this to do what we're doing, so that you can have, a good chance of being able to figure out what the odds are, where the odds are in your favor or against you. Now, I've got some fancy indicators turned on here too. I got one laid over the top of the chart called the bulls and bears. You can see down here in the bottom right corner, it says BNB. That's what's turning the price bars red, yellow, and green. And that's what helps us with our Elliott wave count and also with our Fibonacci rulers. Most people don't see the chart like this. Most people see, I'm going to turn off all my secret little codes in here. This is what most traders are looking at when they look at a chart. All right. This is what they see, and this is kind of traditional. If you were to go out and look on any, web program, go over to Yahoo Finance or Google Finance, and you pull up a chart of Apple, this is kind of pretty much what you would see. Pretty standard stuff right here. I like to use some indicators that make the charts. I call them cheat codes. All right. I call them cheat codes. Let's turn some cheat codes on to help us be able to see better what we're talking about, because we want to be able to easier see the odds of what this market has a tendency to do. So the first thing I'm going to do is I'm going to turn on what I call Fibonacci bars. All right. Now, many platforms are, well, I'm not going to say many because they're relatively new. Some platforms have Fibonacci, some, most don't. Depending on the quality of the application that you have. But in Track and Trade, and I just show you just real quick for those of you who are not familiar with the Track and Trade software, I can show you where you can go get it.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's the software we're using. It's kind of like the Ferrari of trading platforms, and it's designed specifically for the purpose of technical analysis and trading on your market. So you can do everything right here. You open up your trading account, it hooks up to your trading account, and then you trade, and it's got the accounting and everything all right here, and you just trade right here. Your whole world of trading is right here in Track and Trade. You don't have to jump around a whole bunch of different things. Now, there's also other tools out there that we do use, and in combination with Track and Trade, but for your account, your whole account is right here. All right, and that's one of the things that's really nice about it. So one of the secret little tools I like to use, again, is Fibonacci. So I'm going to turn that on and watch what it does to the charts. Boom. Just like that. Almost like, it's like flipping on the lights in a dark room. It's really cool. All right, so that's one of the features that we like to have turned on. And then the other one is called the bulls and bears. And we'll turn the bulls and bears on and off, kind of like a light switch. We can turn it on and take a look and see what it looks like, turn it off if we don't want to see it. But it's based on the Fibonacci Elliott Wave sequence. All right, so it's going to help us do our counts. It's also going to help us with our measures. All right, so that's what we're going to do. And we're going to come in and we're going to come in and we're going to look at that, and we're going to look at some of these other charts. All right, we're going to go through and analyze them. I got a whole list of charts here. We got the Magnificent Seven, and then I've got some blue chips that we're going to go analyze. We're going to look at, and we're going to apply all this so you can just see how it's done. And C-Boss is asking about Bitcoin. We'll go look at Bitcoin. All right, we'll see how that one's looking. We'll do some Fibonacci projections, and we'll do some of that kind of stuff as well on Bitcoin. How's that sound, C-Boss? You want to go take a look at that? Let's get kind of some of these things going, and then we'll see. So the next thing I like to do is I like to right click on here, chart overlay, and I like to turn on bulls and bears. So the bulls and bears is a tool that turns the price bars red, yellow, and green. So it's a little bit different than the red and green. It's just red, yellow, and green. And the reason it has that yellow in there, because we'll talk about Fibonacci. That's the Fibonacci sweet spot. All right, the neutral zone. So a lot of charts are just red and green. They're just like bullish or bearish. Well, markets aren't always just bullish and bearish. Oftentimes they're neutral. So the bulls and bears is a plug-in to Track and Trade. You don't have to buy it if you don't want to. But when you buy your Track and Trade software, if you want to buy that plug-in that helps you turn the price bars red, yellow, and green and does all this Fibonacci Elliott Wave mathematics for you, you can buy that as a plug-in. And then it will turn on and turn the price bars yellow and show you where the neutral zones are. And then it does kind of this counting wave stuff. All right. So we're going to come in here. And the first thing I want to do is I want to pull up our roadmap. Remember our roadmap that we talked about last night? Okay, here it is. Here's our roadmap. So remember, this is the Elliott Wave Fibonacci Richard Wyckoff accumulation distribution model roadmap. So this is kind of generally speaking how a market goes through price and time. Let me go draw you a little picture of this. All right. So I'm going to draw you what happens. I'm going to just use Track and Trade as a drawing tool. So what happens is you have a market that makes these little moves in the market. Let's just draw it like this. So it goes up and down and up and down, up and down like this, right? So we get a little pattern like this. And then it turns and it kind of goes sideways a little bit. And then it kind of starts it over again. And it starts going up and down and up and down and up and down. And then it comes back down like this. And then it starts to go sideways a little bit. And that's kind of what we call a bullish trend, right? If you were to draw a trend line over a long period of time, this might be a whole year period of time or 6 months period of time. Or if you're on a day trade, it might be a whole afternoon. But you get overall, you're getting an uptrend, right? So like this. And so you're getting your nice little 3-drive pattern here. Drive 1, drive 2, drive 3. You're getting your little ABC count back down. Market goes sideways, starts over again. Drive 1, drive 2, drive 3. Get your little ABC, and then it starts to go sideways again. And you get kind of that reoccurring theme going across a market. All right. And that's kind of what we look for. And we call these, each one of these being an Elliott Wave pattern, but this entire thing is called a Darvas box. So we get one Darvas box here. And then as it starts going through again, this little pattern, we get another Darvas box here. All right. And then if the market just continues to make this pattern going up, let's get rid of this auto scale and bring this back. Okay, so now we're going to come in like this, and then it's going to do it one more time. This just keeps, the market just keeps doing kind of this same little idea, this little 3-drive pattern. Now, this is perfect in a perfect world, and it's not always like that. And then it's trying to go sideways. And then maybe at this point, it starts to go down, starts making a pattern coming back down, right? But this is called another Darvas box. So this Darvas box here, and these Darvas boxes, depending on the size of these patterns, could be 6 months, could be a year long. So this could be a 3-year pattern that you're going to see out here as you trade through this thing. This is called an uptrend. Now, a lot of traders will just come in and they'll buy down in here somewhere, right? And they'll hold on to the position for 3 years, 3, 4, 5, 6, 10 years as they go through these patterns. But in the process of going through these patterns, they'll make a lot of money, and then they'll lose some money, and then they'll make some money, and then they'll lose some money. And the whole idea is that at the end of their 3 to 5 to 10 year period, they'll overall they'll still hopefully be higher right here, right? They'll be higher here when they're ready to retire, or when they want to take some money out at the end of their life, or towards the end of retirement, whatever it is. They'll hope that is higher than what it was when they got in down here. All right, even though it went up and down, up and down, up and down, the hope is that over a period of time, the market ends up higher than what it was when they got into the market. Okay, so it takes them over a long period of time. The market will go through all these Darvas boxes. But for us as traders, we want to kind of be a little bit more aggressive. So we want to kind of buy the markets here and then sell out up here, right? Be smart enough to get out. And then as the market comes back down, we can then either make money on the way down, or just kind of sit on our hands, and then start accumulating, getting more in here, and then sell it out as it comes up here and make the money, sell out up here, and then buy back in down here. And then, kind of looking forward to try and maximize our profit potential. And then we're going to buy more down in here, and then we're going to sell out up here as we come up here, sell out up here, and then we're going to buy more down here. And the idea is that over a period of time, we can double, triple, or, hopefully do better than what we would if we just bought and hold for a whole long period of time. Because what would happen is, if sometimes this market starts to come down and you're ready to retire, and right here is where, you decide you want to retire, and you're getting, after 5 years of sitting in the market, you're making exactly the same amount as you were 5 years later. You didn't take any profits along the way. You didn't maximize your potential. You didn't sit out of the market when it was in downtrends. You didn't do anything to try and help yourself become a better trader or more money. And a lot of you will see this represented in maybe your 401ks or IRAs. You've been working for 30 years, and you look at your 401k, and it's, you've been saving for 30 years, and there's $100,000 in there. It's like, wait a second. I thought I was supposed to be rich, rich, rich beyond my wildest dreams. Where's my millions and millions that I'm going to live off when I retire? Well, it just so happens that you just, you bought here, and over your life period, you just kind of every 2 weeks, they threw money into the market. So, you end up with a whole different story of where all your money went, and you end up with, buying high and buying up here and buying up here, and then it goes down. You buy here and you buy here, and you bought here and you bought here and you bought here, and it ends up dollar cost averaging your position up, and then you end up compounding your losses on the way down. And then you get up here, and it's just, you bought here, 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 and then you're continually dragging your average position up. And so every time the market turns and comes down, you're compounding your losses all the way down. And that's why you end up with no money at the end of your life, because you just sat there and held on and added through your position your whole life. I know that's what they tell us to do, and that's what they'll tell you. And they'll still tell you, a lot of people tell you that's the best thing to do, but you can see from your own 401k what the results of that are, right? At the end of your life, you end up down here, and you've compounded your losses down, and you end up with the same amount of money, or not much more than what you put in yourself all the way through. You didn't make anything, right? You probably put in 90,000, and now you've probably got 110,000, and then throughout your entire life. And so, that's kind of the process. So the whole idea of what we're trying to do here is just try to do a little bit better in our 401k, see if we can't beat it, right? I'm not saying not to do a 401k. I absolutely do a 401k, but on the side, if you got a little extra money, let's see if we can't beat the 401k, so that in the end of life, we can add that to our position, right? If it's a little bit too much for you, you don't want to do it, don't do it. Just live off your 401k and Social Security. That's okay too. This is kind of your choice. You can do what you want. I'm not saying you have to do this. I'm just telling you what I do. And if you want to do what I do, well, this is what I do. So I'm here to tell you what I do. I'm not telling you what you should do. Just giving you some ideas. Okay. I just want to make sure you got some better ideas. So as you can see, as we come in here, you can see that we got a top up here. This is drive 1, counter trend, drive 2, counter trend, drive 3. And then we went down through this little narrow channel, right? This is called the accumulation stage right in here. And then we started with the drive 1 again. So there's drive 1, there's a counter trend, there's drive 2, counter trend, there's drive 3. So you can see in here that this market just has a tendency to run through this little roadmap, just kind of like a train on rails. Now, does it always do this little roadmap? No, not always, but it's pretty darn good at predicting what the market's doing. You can see we went through the accumulation stage. We went up through the drive 1, drive 2, drive 3. We got up to the top and then turned around and came to back down. And usually it comes down half or 50% of the last major move. So if the market went from here to here all the way up, usually when it comes down, it goes down about half and then it starts to go back up again. That's called an uptrend. All right, it's making higher highs and higher lows over a long period of time. That's an uptrend. If it turns around and starts to go down, starts making lower highs, lower lows, that turns into we're now in a bear market, right? The market's going down. That's how we as technical analysts can determine for you, oh, we're in a bear market or, oh, we're in a bull market. How do you know? You're driving down the road and you hear some guy come on the radio and says, well, today we became a bear market. Well, how did you know that it became a bear market? Well, because we're no longer making higher highs and higher lows. We're now making lower highs and lower lows. We have rules in the market that make those determinations, and they're all mathematically modeled out. So we know exactly when a bear market starts. We know exactly when a bull market starts because we know whether markets are making lower highs and higher lows or lower lows and lower highs. And those things, those little turnaround points, those little reversal points from low to high or from high to low are what determines whether in a bull market or a bear market. All right. So very simple stuff. Nothing real complicated there. We're just looking for markets that are going through accumulation stages. And then as the market starts to go up, now you're going to notice a little indicator down here. This little indicator is called the chalk and money flow. And it was designed specifically to help commercial traders. Actually, it's to help retail traders know what commercial traders are doing. All right. So that's the way it was designed. So down here, you'll notice that these are green. It's like, wait a second, the market's coming down. Why is that green? Well, those are buy zones. All right. Those are buy zones. Because remember what we talked about last night in class is that retail traders have a tendency to build upside down pyramids, right? They like to build upside down pyramids. They like to come in and they like to start to, let me get my upside down pyramid. They like to come in and they start to buy right here, right? And they buy. Come on, Lan, get your arrow in there. So they'll buy here and they'll buy here and they'll buy here and they'll buy all the way up the uptrend. Well, if you're buying all the way up the uptrend, you got to ask yourself, who's selling to you? Who's selling to you all the way up an uptrend? It's such a beautiful uptrend. Why would anyone sell me anything? Well, it's the commercial traders. The commercial traders, they bought down here. They went through what they call the accumulation stage. So they bought a whole bunch of shares down here, and then they're building what they call an upside right pyramid, a very a good strong pyramid, right? Big stable pyramid with disappearing pyramids. All right, big stable pyramid. All right, so they got a big base down here like this, and lots of shares down here. This is called dollar cost averaging. And so they dollar cost average down. All right. They're buying all the way down and out downtrend. That's why all these green markers on the downtrend. So when they get down in here, they end up buying all this and buying on the downtrend. So their dollar cost average is way down here. So they have lots of shares down here. And their average price is right here. This is kind of where their average price ends up, right? Well, retail traders, little guys like you and me, we start to buy here. And we buy all the way up the uptrend. We end up with a big upside down pyramid so that our average price is up here. See the fallacy in doing that? If you end up with an average price up here, all the market has to do, let's say your average price is right up in here somewhere. You have kind of a base right in here. All the market has to do is drop that far and get the right tool. You click on that tool and then you get a little arrow. And then if the market just drops that far, that's all it has to drop. If you have an average price at, $270 on Apple and the market drops back to $260, you lost everything. You're completely out. You're desolate. You have no money because you build an upside down pyramid and you've drawn that dollar cost average up. And every time you buy, it pulls that average up. Your average price is way up here. All the market has to do is drop that far and you've lost all your money. That's why retail traders generally lose money. All right. And that's why big institutions take your money. So what happens is you got to start being like a big institution. And that's the whole idea of what I'm trying to teach you. Now, there's nothing wrong with doing this. There's nothing wrong with buying up here and buying up here and buying up here. And we teach that, right? That's what the A drive, B drive, the C drive is, and where to buy. But the whole idea is that we want to be starting to sell out when we start getting up here where the probabilities are really bad in our favor. If the probabilities start going into that third drive, that third Elliott wave, and man, we're starting to buy real heavily up there on a C2 and a C3, we're doing the wrong thing. We need to be selling out up in there and getting rid of all of our positions, because that's where the market starts to flush down. So we can buy and be good about this. And there's a strategy that we call pillaring. All right. And pillaring is not building a pyramid. Pillaring is building a pillar like this rather than a pyramid. So what we do is we come in, and as we go up, we buy, and as we come down and start to come in, start to go up, we start to sell, and then we buy, and then we sell, and then we buy, and then we sell, and then we buy, and then we sell. So we're doing a pyramid in here. We're taking profits along the way so that when we get up to the top, we're not sitting here holding this giant position. We've been liquidating our positions along the way, so we might start off with 100 shares down here. And at any given time, we might have 200 shares, but then we take some profits. We're back at 100 shares, 200 shares, 100 shares, take profits, buy more, take profits, buy more. But by the time we started down here with 100 shares, and when we get up here, we only have 100 shares. But along the way, we sold out, bought 100 shares, sold out 100 shares, bought 100 shares, sold out 100 shares, bought 100 shares, sold out 100 shares, all the way up this pillar. So when we get to the top, we're not holding a huge, big chunk of money. All right. Now, for those of you who are familiar with the high yield ETF funds, what we call yield first investing, this is what they do automatically for us on our behalf. So we put our money into them, and then because they're doing yield first, what they do is they take money out along the way, and that's why you get a distribution every week or every month, is because they're taking money out along the way, and they're building themselves a nice, a nice pillar along the way. So you get a whole bunch of little tiny pots of gold along the way, but you don't end up with one great big pot of gold at the end of the rainbow, which might end up being up here. And that's a bad place for your big pot of gold to be, because if it's up there, the market only has to drop this far and you lose your entire pot of gold. All right. So by taking little pots of gold along the way, by taking those distributions every week or every month, when the market flushes like it's doing right now, well, we don't have a great big huge pot of gold at the top of the rainbow unless you kept reinvesting, dripping your money back in. This is why I say don't drip, because if you sit there and drip your money back in, you're doing, in essence, exactly the wrong thing. You're building an upside down pyramid, and every time you drip back in, you're going to put your money in there, and that your position keeps getting bigger and bigger and bigger and bigger, and up at the very top. That's why if the market flushes just a little bit, your portfolio looks horrible. You're like, oh my gosh, I'm losing all kinds of money and I'm in this high yield fund. What's going on? Well, you dripped all the way back in and just kept throwing your profits all the way back in, all the way up the trend. And then when you got to the top, you didn't take it out. You let it sit there because, well, I'm getting dividends. So you left it in there. And now you got this great big, huge, giant position up at the top of your upside down pyramid that you did yourself. You built it yourself. They were taking profits along the way, but you were just stuffing it all back into the exact same thing you're pulling it out of. And that's how you ended up with an upside down pyramid doing high yield funds. And you just destroyed your entire marketing, your whole effort of trying to, why are you taking them along the way, taking profits along the way, if you're just stuffing them right back in? And why'd you take them out in the first place? Exact same concept, right? That's why I always tell you, don't drip your money back into these high yield funds. If you just keep putting them back in as the market goes up, you keep dragging your average price up higher and higher and higher, and all the market has to do is just tumble that far, and man, you've lost everything. So a lot of portfolios right now, the market's flushing like a toilet, and because they kept cramming all their money back in and they draw their dollar cost average up, and they're losing money. They're, and I've done a little bit of it myself. I'm not going to say that I'm perfect, because I've held a lot of money out because of that, and I sold out of a lot of positions too. A lot of I had a whole bunch. I had 3 or 4 Bitcoin positions I had actual Bitcoin. I was trading Bitcoin, and I bought it down to 100,000. Went up. I sold it out all the way up, and everybody's like, "Oh, you're dumb. You're dumb, Land. You sold out all of your Bitcoin at the, so you took all your profits along the way." Well, now Bitcoin's flushing like a toilet, and I don't have any Bitcoin. Why? Because I sold it all at the top. So I was taking profits along the way, and I wasn't pumping them all back in. I was taking those profits, putting them in other places. But even some of our high yield funds, we like to reinvest them, but I don't want you just to drip it back in and just stuff it right back into the same thing you just took it out of, because that's going to build an upside down pyramid. And then when the market flushes, yes, we have high yield, and they will eventually catch up as the market will stop falling, right? The yields will start to pay on the way down. And then what it does is it pushes out your break even. So you go from being maybe a 6 month to break even to, or 9 months to break even to now it's a 10-month break even. Now it's an 11-month break even. Now it's a 12-month break even, because the market keeps coming down, and those high yields are going to have to pay off that big loss that you're accumulating on the NAV, on the net asset value. So now it keeps pushing out your break even. Now I'm not going to break even for 5 years or 6 years, or high yields you can usually do within a year. So it's like, now I'm going to be, now instead of, I had it down to where I was going to break even at 6 months. Now I'm going to be 7 months. Now it's going to take me 8 months, maybe 9 months, maybe 10 months before I'm going to break even again, because I had all my NAV pushed in there at the top of that pyramid, and now it's flushing down, and I'm losing all my money. And now those high yields are going to have to work hard to try and pay back all those losses, and it's going to push all that clear back out into the future again, where you were almost break even. You almost had a cash cow, but now that cash cow is pushed all the way out from 6 months to 7 to 8 to 9 to 10, and it's going to just have to sit there and wait longer for those high yields to be able to pay off those losses. And the more you stuff that money back in up those big trends, it's beautiful and it's fun to look at the time. Look at how rich I am. I'm wealthy beyond my wildest dreams. But that's because you stuffed all your money in, and right up here, this is where everything's sitting. And now if these markets flush, oh my gosh, down it goes. All right. And down goes your wealth. So you have to manage it a little bit more strategically. That's all I'm trying to say. And there's strategies for ways to do that. That's why I tell you, don't drip. Be strategic about where you put that money. If they're going to give you some dividends, don't just stuff it right back into the same thing you just pulled it out of. There might be a reason to put it somewhere else, all right? Or leave it on the sidelines. If market's starting to get really overbought and way up there, really high, toppy, why are you stuffing money back into it? Right? They pulled it out for a reason, to give it to you, to sit it on the sideline. It's real dangerous up there. Don't put it in up there. All right? Okay, so that's kind of that little rant and rave. Hopefully that was helpful, and you kind of got told off a little bit. All right, so that's what we're looking at here. And you can see that Apple is now up here at the very top of a 3-drive pattern. And if you're starting to stuff money into your Apple portfolio, whether it's new money that you've got from McDonald's or whether it's distributions and dividends, and you're stuffing it in up there, you're dragging that dollar cost average up. And all Apple has to do is make a nice little ABC retracement coming back down here like we anticipate it's going to do, because that's what it generally does. Not that it says that it's going to. It doesn't mean it can't go to a 4th drive, 5th drive, 6th drive. Certainly can. It's just the odds are not in your favor to do that. All right. The odds are saying, hey, look at this. We got a 3-drive pattern. If we look at this, let me shrink this down a little bit so you can see it a little better. So look at this comparison. Look at this right here. This is this right here. See that? Can you see it? All right. Hopefully you guys are getting sufficiently cussed out for putting your money back in. All right. All right, so hit this little spot right here. See this little spot right here going sideways? That's this little spot right here. See these drives up here? Drive 1, drive 2, drive 3. See that little chart, that little sideways mark? That's right here. This is the first drive up. That's the little sideways thing right there. See that? And then we go up one more. And then we got a little sideways thing. That's this one right here. See that? Now we're going to go up one more. There it is. There's a little topping formation right up here. That's what's happening. So does it mean it's going to fall like this? No. But heck, it's done this one perfectly. What's to say it's not going to continue to do this one perfectly? I'm not willing to say it isn't. I'm not willing to say it's going to go one more. This is where it generally goes. This is kind of the roadmap of the markets. What makes me think that I'm going to go in and say, oh, yeah, heck yeah, I think it's just going to keep on going and start pumping my money back into it? No way, man. No way. This thing's going to come down. I think it's going to come down. And how far is it going to come down? Probably going to make a little ABC pattern, just like we saw here. And this is where we use Fibonacci. We use Fibonacci to help us decide how far it's going to come down. So what we're going to do is we're going to just go from the low just right in here, the low of this right here. And some guys will go from all the way down here at this low here. So you can go all the way from there. But I'm going to just take it, just be a little bit more conservative, and just say from this accumulation zone right in here. And you can see this accumulation zone kind of went into a little triangle for a little wedge pattern, didn't it? Let's do it this way. Kind of went into a little wedge pattern like that. And then it broke out the wedge pattern right there, and that's where it took off like a rocket ship and started to go up. And then it kind of did its little pullback in here, it's a little ABC, but then it did its 3-drive pattern right here. You could almost call it a 4-drive pattern, couldn't you? 4-drive pattern, but this is kind of stayed below this previous high, so we don't count it as a drive, right? So as long as it's like in there, see it kind of come up, test that, and then that's where it took off and broke above right there and started that next drive right in there. See that? Boom, 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 boom. Away it goes. Now, that's really cool, right? That's really cool how this works. So we have all these little patterns in here, and these little blue lights kind of tell you where these little triangle and these little wedges go, just like that, just like that. Okay. All right. So that's kind of how that works. It's kind of cool, right? So what we're doing now is we're going to say, well, if this is the Fibonacci ruler, and we're just going to measure, and you can measure little Fibonacci rulers too, right? We know that. We can come in here and we can measure from here to here. And how far back is it going to come? Well, this one came right back down. You can see it went up, and then it turned around and came right back down to 38.2. And then it went up again. It kind of had a little jig and jog in here, but we're going to take our little Fibonacci ruler and we're going to just draw from here. Again, you don't have to do the math for Fibonacci. You just have to draw it in there. And you can see the market went up from the bottom of this Fibonacci ruler, it turned around, came back down, came down to 38.2. Use that as an area of support and bounced off. It's really strong. Usually it'll come down a little bit further. We like to see it come down into the 50, 61.8. That's called the Fibonacci sweet spot, right in there between 38 and 61.8. This one bounced off at 38. That's when a market's strong. It comes and touches the 38 and then goes up from there. That's where we put in our first order. We buy some there, we buy some here, we buy some here. All right. So we have a 3-tranche portfolio. So when it hits 38.2, we can buy in there. When it hits 50, we'll buy a little bit more there. And when it hits 61.8, we'll buy there. We might not get the opportunity to put it in at 50 or 61 if the market's strong. We just have to go with a smaller position right here because we don't know. We don't know that it's going to go up straight off 38.2. But we could also come in here and draw a trend line in here. And we can say, well, if it breaks and gives us the first green candle to break a new high, we could get in and add a little bit more in there too if we want to. We could also add a little bit more in here when it breaks above those blue lights, or even some people like to buy on a break above a previous high. That's really popular. I'm not really one of those guys. I don't like to buy on a break above a previous high. But, you know, if the market's pulling back and giving us a little opportunity, you can do that too. So you put your money in there and ride it up. And then once it gets up here, when it crosses this natural trend line, or this, which generally comes in at the same spot as this blue light right there, that's where you'd liquidate your position and get out, take your profits from where you got in, right? Get in here, get out up here. Now, this will work on a daily chart, 1-minute chart, 5-minute chart, 10-minute chart, whatever time frame you want. This is still the same strategy. It's called fractal. And so all these patterns reoccur at the exact same time. Pretty simple stuff. I mean, we're not, you know, sending man to the moon right here. We're just looking at pullbacks and resistance and support levels. That's all we're looking at. And then when it breaks a trend line, we get in or we get out. That's all there is to it. All right. Nobody's perfect. Nobody knows exactly. So you just kind of put your order in there. And if it's wrong, just get out, take a little tiny loss, and try again next time. All right. But don't rush it. Don't try and do too much. Just keep it simple and don't overtrade. All right. So this is what I'm looking at right now on Apple. I'm anticipating that this market's going to come down with a little ABC pattern. Am I going to be perfect? Nope, but I'm going to make a good estimated guess in here. Then we're going to get this market to come down here off of this little Fibonacci top formation, maybe 130.8, little ABC top, and come down, and we're going to be down here somewhere in this Fibonacci sweet spot. Does it mean that it can't just come down and hit that 38.2 and be a strong market and take off and go back up and start making ups and downs again, go in this direction? No, it certainly can. Can do anything it wants. That would be a little head and shoulders formation like we talked about last night in class, right? Oh, grab the right tool and this one here. So we go left shoulder, neckline, head, right shoulder down in here somewhere, maybe a little right shoulder up in there. If it breaks and comes down here, this is where we'd look for this market to come down. That would be our little breaking off the top formation right in there, right? So we look for this market to come down somewhere in this region here. This is where we'd start to be a buyer. This is where we'd look for this market to start to give us an opportunity to maybe buy here, maybe buy here, maybe buy here. So down in this region here, this is where we'd like to see it come so that we can buy low, buy the dip, right? But right now, we don't want to be buying up here. There's a really low probability that we're going to be successful up there. Doesn't mean it can't. It could certainly go up to a fourth drive. But even if it goes up to a fourth drive, the chances of it going up and making a fifth drive are really low. So it'd probably pop and come back down like this. But that's what we're waiting for. They're going to get up in here. The probabilities of being successful up there is too low. So we don't really want to put our money in up there. That's all it's saying. All right. Doesn't mean it can't go higher. Certainly can. It's just that the probabilities are really, really bad for us. All right. Let's come look at Amazon. So here's Amazon. Amazon's kind of doing a funny little thing in here. Look at our 3-drive pattern on Amazon. We got drive 1, drive 2, drive 3. And then it started going through the sideways channel, just like in our book. But in this time, instead, it kind of broke out the top, had a fake breakout up here. This is what, let's just come and pull up our map again. And what does our map look like? So if we were to compare this to our map, we're going to get something like this. Oh, look, that little spring right there. Oh, look at that. It's just like, oh my gosh, like a train on rails. Drive 1, drive 2, drive 3, the little sideways, drive 1, drive 2, drive 3, little sideways, the little spring right there, just like we drew it in the picture. Holy cow. You'd think I made this up from this picture. No, I drew this years ago. All right. Now we're going to come down the other side. Now this one kind of had a funny little thing where it popped way up there. So it kind of surprised us, didn't it? That's a surprise, not something we anticipated. But nonetheless, it did go up and kind of made a little 2-drive pattern down off of here. Drive 1, counter trend, drive 2. And then it took off and rallied again. Now it's flushing down here. So in reality, what the surprise is this flush here. It's come back a little farther than we anticipated. Maybe it should have only come back here and then got up again. It's come down farther than we anticipated. All right. So if you take your little Fibonacci ruler, we draw it from the very lows to the very highs up in here. You can see that this market made this little topping formation, just like we saw on our map. And then it came down, made a little ABC pattern, came down to 38.2, and that's where it took off again. So now it's starting to come all the way back down again. This is really surprising. So what are we going to look at from here? We don't know. It's kind of doing something out of the ordinary. So we're going to have to sit on our hands and wait and see. But we would probably anticipate that there's going to be some sort of a little ABC at some point. So we're going to probably come down, probably pull back up a little bit before it drops and comes down again. If it does drop and come down again, it'd probably come down depending on where it goes back up here, right? This is what we'll be looking for to count and measure with this little ABC tool. Now, this little ABC tool is this little tool right here, and I use it all the time to kind of make these Fibonacci projections. And I'm going to go show you the settings. So this is the preferences for this tool. Now, this is really important because it doesn't come out of the box like this. Let me move me out of the way so you can see it. Get out your little cameras and take a picture of that screen right there, because you're going to want to set up your software to look like mine. Right? And so that's how I have mine set up. And I like to use my tool like this because it doesn't come out of the box like this, but it's got all these capabilities. And so go ahead and take your camera, and I'll leave that on the screen for just a minute. And you can go ahead and see how I've got my tool set up. Now I'm going to make mine a little thicker here. Go there, make it a little deeper so you can see it better. I save that as my defaults, just like that. All right, there's another little line in here that I like to draw sometimes, but I'll turn that off just to keep the screen clean. But that's just a line coming across that low level as a breaking below the natural low or the natural high. All right, so you got that all camera out there taking pictures of it, so you can put that into your own settings. Now, what this does is this is just a little tool. It's a Fibonacci tool that kind of helps us project into the future where we think markets might go, and that's what we use it for. All right, so we use it to kind of, you can just kind of use a past performance to see what it did, right? So we come in here, that rallied first, it pulled back, and then it went up. It kind of hesitated right here at the previous high, and then it went up and ended up right at about 90%. Now, it was a little slower going up the second time than it was the first time, right? So it went up really fast here, but then the next drive was really slow. It still went up. It just went up really slow to about 90%. Again, remember, anytime you expect a market to go 100% of anything, you just don't expect it to do 100%. And the markets are lazy. People want to panic first. They want to be the first ones to panic. So that's why it won't go up to 100 oftentimes, because that's where everybody would panic. And so everybody starts panicking at about 90%. And that's why it flushes out a little early sometimes. And that's just the nature of the beast. And you just kind of know that and understand that that's what happens. So you might not realize that for years, but now that, because you've listened to me, and I've kind of took me years to realize that, now I can tell you, now you know it. Okay, so same thing here. We come down, got a little up, and then the little back down, it came down to 90%, just like that, just like a train on rails, right? Just like I said. So that market came down, had a little pullback, came back down. Instead of going to 100%, everybody panicked at 90%, and that's where they started to buy back in. So you can see it going both directions. So you can come down here and you can just go back in time and use this little tool to help you identify. And you just kind of, wherever the blue lights are breaking, that's kind of where you just put it, right up to here and then down to here. And then it tells you, oh, look, it went right up to 90% again. Just like Lance said, man, he's smart. He's a smart bugger. How did he know that? Well, I didn't know it until I figured it out. All right, so then we come in, we do it again. Now that one went right up to where? Oh, gee, right up to 90% again. So we just draw our little line across there. Look at that. It went right to 90% again. So that's kind of how you use that little tool. And it just kind of projects out into the future where we're going to anticipate those markets going to. All right. So that's why that works. That's how we use it. So now here, oh my gosh, this is kind of being crazy. I don't really know. It's not being any kind of pattern that I really like. If it was to turn around and start to go back up, 90% right here, just basically at the previous high. So I don't know. It hasn't turned around and started to go back up yet. So we're still going down. So if we want to project to a downside, well, we would maybe do something like this. But it's right now, it's just being really weird. It's being stupid. So we're not going to really kind of anticipate much. Right now, we're just going to say maybe it'll come down and test this previous low, and maybe it'll bounce off of that region there somewhere down in here before it turns around. Right now, you can see that our indicator is up here saying that we're in a sell zone, obviously. All right, so getting ready to come down into the buy zone. As it comes and crosses down in here, it should start to turn green down in here, and then we can start to be buyers down in here. And this is where we'd want to start buying up again. Of course, that would be a Fibonacci ruler from the bottom to the top. And that'd bring us right down here into the Fibonacci sweet spot. And it's kind of entering into it right now, right in here. So that's kind of where we're at now. So we can kind of be buyers down in here as we start hitting that Fibonacci sweet spot. If you want to get into some Amazon, or if you want to reinvest some of your dividends into Amazon, this might be a spot where you might want to start doing that. Okay, because we're getting a nice little pullback here, but it's still flushing. So I would kind of wait and see. I want to wait and see it stop. I want to see it kind of stop flushing and start to go sideways a little bit. The biggest thing people get concerned about is that it's coming down. They're afraid they're going to miss it. It's going to suddenly just go like this. That's really rare. Not that it can't. That's called a V recovery. And sometimes the market will come down and just turn right around and shoot right straight back up. But it's really rare. Usually markets come down and then they go sideways a little bit, right? They do this kind of little dilly dance here before they start to go back up again. This is called the accumulation stage, where the banks and hedge funds start buying in. All right, so you get these accumulation stages. These are just sideways trends. And so you kind of watch for those. And that's where you're going to kind of see where markets are starting to see this. This is where that big buy zone comes in here. That's why it's all green, because they're buying all down through here, bringing their dollar cost average down, making themselves a nice, big, beautiful, pyramid scheme down here. They're just getting a nice pyramid down there. All right, so that's what's the comp process here. So this is way up the very top. We're just waiting for it to come back down. So we'll come over here and we'll go to the next one. This is the Dow. This is the Dow index. So this is what's flushing right now. This is what we've been calling for, because look at this thing. It's got like one drive here, another drive here, another drive here. So we got up to the third drive, and then it broke and did a fourth drive. Look at that. Crazy, crazy market. What in the heck? What the heck is going on here, right? So we end up with a area of resistance here. This becomes what we call a Fibonacci bow tie, right? Remember the Fibonacci bow tie from last night? It's come up, and it's kind of a weak bow tie. It's not a very strong one based on what the market's done in the past. But Fibonacci bow tie goes like this, right? Let's just take this little tool here to draw our Fibonacci bow tie. Comes in, comes down, comes back up, makes that first triangle, right? And then what we're going to do is make the bow tie go on the other side. So then we do an anticipated market going up like this, coming back down and creating a bow tie there. So that's what's happening here. It's just that it got weak once it got above the previous high. That's why I don't like to buy on a break above a previous high. I like to buy down in the dips, down in here, down in here, down in here, as this market's coming up, so we can ride it up into that next bow tie. Oftentimes bow ties are kind of weak up above the previous high. They don't get real strong up in there. And as you can see, that's where the third drive started going. And they got a nice little fourth drive up in there. But nonetheless, we're kind of petering out right up in here, and it's coming back down. So where will it come down to? Probably somewhere right around that previous high. That's probably where it'll come to. So you get your little bow tie like this, and then it's going to go up and then come back down to the previous high and use an area of resistance, right? Resistance here to be support here. And that's the crossing zone right in there. So that's your bow tie, Fibonacci bow tie. That's what the book's named after, right? So that's kind of what we're looking for. So we'll start to look for being a buyer. Now we can draw a Fibonacci ruler all the way from the low to the high, just like that. And we would anticipate maybe the market coming maybe back down into this region here. That would be a long ways down, but that's kind of what our numbers are telling us, isn't it? So down in this region here, this is where we'd start to look for an opportunity to be a buyer down in here. Now, that was my alarm, just went off. The market's closed. All right. Markets have closed. That doesn't mean we can't still look at our our current markets, though. We're still looking at what's going on here. But that's kind of the fallback that we'd be looking for on this Fibonacci bow tie against the Fibonacci numbers, all right, down to the Fibonacci sweet spot. So kind of anticipate that that's where that market's going to go. Now, the news is going to freak out. They're going to blame everybody and everything, probably the primary, whoever's in office at the time, whether it's the Biden administration or the Trump administration. When a market falls, it's always their fault, right? It's always their fault. Whoever's in office is their fault. No, it's not. It's just the banks and hedge funds taking profits. It's just kind of the natural ebb and flow of the Elliott waves, the Fibonacci rulers, and of course those guys and all the things they do have a little bit of influence on it. But for the most part, we're just watching the normal ebb and flow of markets, right? Fibonacci bow ties playing out with the system. And this is how big banks and hedge funds make their money. They buy at the bottom, they sell out at the top. Once it gets to the top, they want to make more money. So they've taken out all their support, and so it flushes the market. The market flushes, and then they start buying again. They start buying down here, accumulating, and then they drive the market back up. Then they sell out all the way back up. So it's just a big game that's being played, right? And so that's how the game's played. So let's come over and look at the Google in here. Now, Google going straight up, right? Nice, lots of, look at this. We had our nice little accumulation stage down in here. Let's back up just a little bit. Is it always perfect, just like the manual? No, not always, but you can pretty much derive. I mean, you can look at the map, right? Look at the map, and you can pretty much see the market doing exactly what's on the map. I mean, look at this again. Even even where it doesn't look exactly the same, it's pretty much the same. See this accumulation stage right here? That's this right here. All right. And then we started the drives up, drive 1, drive 2, drive 3. And then we got up here and we got a fourth drive. Oh my gosh. We went up into a higher point up in here. Right. So that's okay. It doesn't mean it has to stop at 3. It's just saying that the probabilities of it going much higher after 3 starts to get lower and lower and lower. And we don't really want to be stuffing money into the market up there, because probability is that it's going to come back down and make one of these little retracements. Right. So this is our accumulation stage right in here. And you can see right here, it's telling you this is where the big banks and hedge funds are buying. And then, of course, this is where they're selling. They're selling out. And who's buying? We are. Retail traders. We're buying. We're building our upside down pyramid. Drive 1, drive 2, drive 3. There it is. You can count this one as a drive, but this would probably still be part of your accumulation stage right in here, right? So this is the accumulation stage. And if that's the accumulation stage, there's your drive 1, there's your drive 2, there's your drive 3. Now, if we come over here, we're at the top of the third drive. Or even if you want to call this one drive 4 and not part of the accumulation, you shrink your accumulation, say, well, that's where it went, broke up. Okay, well, you got 4 drives then. But either way, do you want to be stuffing money into the market up here? Oh, hell no. Are you kidding me? I want to be selling out just like the big banks and hedge funds are. I want to be doing what they're doing down here. See that? They're getting out of the market, man. They're bailing out. They're selling everything they got. They're taking their profits. All right. And so what's going to happen? We're going to anticipate the same thing that's going to happen with Google that happened with we're going to anticipate with those other markets. All right. We're going to come in here, draw our Fibonacci ruler from the very bottom to the very top, and we're going to anticipate this thing's going to come back down into the Fibonacci sweet spot. We're going to make a nice little head and shoulders formation up in here, probably left shoulder, a little neckline here, a little head up in here. We'll come down, make a little neckline here and a little right shoulder up in there. So we're going to get another little topping formation like that. And then we're going to anticipate this market's going to flush out and come down here into the Fibonacci sweet spot. And the news is going to go ape shit crazy. All right. They're going to start blaming Trump for everything. Oh, it's always his fault, or it's always Biden's fault. Whoever's in office gets in trouble for it. But this really has nothing to do with them. It has to do with the accumulation distribution model that was drawn 50 years ago. This has nothing to do with Trump. It has nothing to do with Biden. It has nothing to do with the federal government. It has to do with banks and big hedge funds like BlackRock, Vanguard, State Street. They're the ones who do this, right? This is how they do it. So when you see these patterns like this is what you're looking for. And so the market's going to probably come some sort of a way. It's going to come back down in this region here. This is where we can start being buyers. This ends up being one Darvas box, right? That's our Darvas box. And then we'll anticipate a new Darvas box starting out here. Now we can go back and see where the Darvas boxes were out here. We can say, oh, well, here's Darvas box, drive 1, drive 2, drive 3. And then we got a little big retracement back here. And that Darvas box ended up clearing the hell back down here. Oh my hell, look at that Darvas box. So this Darvas box going to this next Darvas box wasn't much of a big gainer, was it? Now it was. It came right up. Look at that. Oh, I guess it's a big gainer after all. This was a small Darvas box in comparison to this Darvas box. But we're going to see this Darvas box come back, and then we'll start another Darvas box. Now, the question will be, will this Darvas box be bigger than this one, smaller than this one, or will it be a bearish Darvas box? Nothing says it has to go up. It could be a bearish Darvas box and we start the market coming down, right? Because we could do that too. Markets don't have to always go up. Sometimes they go down. We could get a Darvas box coming back against us. So that could be the what we see here. All right. But nonetheless, if you go back even farther, now we can see another Darvas box back here. Look at this. You thought I made this up, didn't I? Look at this. Drive 1, drive 2, drive 3, counter trend ABC. There's another Darvas box right there, from there to there. You want to go back one more? Let's see if there's another Darvas box. This is Google. All right. Here's another Darvas box right here. Look at this Darvas box. Drive 1, drive 2, drive 3, counter trend down. There's another Darvas box right there. How many more you want me to go back and show you? You think this doesn't work? You think I'm making this shit up? You think I'm pulling it out of my ass? I ain't pulling it out of my ass. This is drive 1, drive 2, drive 3, counter trend. Just like that. There's another Darvas box right there. All right. I'm not making this up. Okay. Look, it happens over and over and over and over and over again. You can go do that on your own. Go look at every chart. Now, not all charts do it. But some of these more popular charts, like the Magnificent Seven specifically does it, because these are the ones that the great big huge banks and hedge funds, they're the ones that are doing this. All right. They're the ones that drive these markets. And you can see it just one right after the other, right after the other, right after the other, right after the other. All right. Now we're getting pretty crazy. Look how much bigger this Darvas box was than the previous ones. I turned off that scaling so that it shows you the scaling of the size of the Darvas box. Oops, that was a mistake. Now I don't know where I'm at. There we go. Oh, I got to bring it out here to the future. Play. Okay. So that's how this thing's working. Let's go and look at, that's Google. Let's go look at Magnificent Seven. Now this is all of them combined into one. I'm going to skip that one. I'll let you do that one on your own. We're going to come out here and just stick to the individual stocks. So look at this one. Look at this market. Holy cow. This is Meta. So this is drive 1, drive 2, drive 3. This is our counter trend right here. And we're already on the third drive down. If we come back with our Fibonacci ruler, we're going to come up here and look at this. This thing's already way back down past the Fibonacci sweet spot, coming down. It's really tumbling down. So this is starting to get into a spot where we want to start looking to be a buyer, right? Look at this. Okay, down in here. Look at this. These guys are getting ready to buy. They're buying, building their upside down pyramid, building their upside right pyramid. So they're going to come in and, right, just like this. Oh, disappearing pyramid. So they're going to start building their pyramid here. And so that's what we want to do. We want to start building our pyramid. Now, we don't build a pyramid like the big institutions do, because they got a lot bigger, deeper pockets than we do. So they're starting to buy right in here, and they're drawing their dollar cost average down as they pick up more shares, right? And that's what they're doing. So they're buying up in here as the retail traders are selling out, right? Because they're losing all their money. And so they're selling. And the big banks are buying. So they're buying, bringing their dollar cost average down. And then they'll take it through the accumulation stage down in here. And then they'll turn it and it'll start to go back up again over here. So that's how it's going to work. And that's where we're at here. Stop, auto scaling me. And so that's how that's working here. Now you can go back in time and look at it back here, and you can see the drives coming up here. So there's just drive 1, drive 2. We kind of went sideways, got a little drive in here, a little sideways, another little drive in here. So that was quite a move there from Meta coming up through there. But then we got our ABC down, just like that, ABC down. And now it's starting to turn and went back up again. 3 drive pattern, drive 1, drive 2, drive 3, ABC, and it come down 3 drives, drive 1, drive 2, drive 3. Now you keep this little topping formation in here, and there's your drive ABC pattern right there. And it's easy to see in hindsight. It's hard to see afterwards, right? I mean, as it's doing it, you're not exactly sure what's going on, but you can see it afterwards. And if you go back and do enough of this, you get enough confidence in it that you're saying, well, that's probably what it's going to do. It likes to follow this roadmap. That's why I gave you this roadmap. So you can set that up, print it out, put it on your wall, and hang it up, and just try to identify, where am I at in the roadmap? And what are my odds? What's the odds that thing's going to go higher after this third drive up? Well, probably not very good. I don't think I'm going to start stuffing money into that market. I better not, because the market's probably going to come down. I'm going to hold on to my money and wait for the market to come down. Then I can start stuffing my dividends back in down in here. That's what I do. Here's Microsoft. Ooh, look at that. That's just one crazy market. That's just outrageously weird. But, then we got our little, starts moving our little market in here, and that's kind of going back through the little ABC patterns. We're going to come in with our little Fibonacci ruler, draw it up there. We got a nice little beautiful double top up in there. Look at that, just like a train on rails. Got our little ABCs in here. Now we're coming back down. We're going to come back down into where? The Fibonacci sweet spot, right down in here. And so this is what we're going to see. And then this is where the market will start to go sideways. You're going to see that little sideways dance, and it's going to be really funny down in here. You don't want to get in, and that's okay. Start accumulating some shares down in there. What if it goes up and then comes down a little more? That's okay. Just accumulate some shares down in here if you can, or if you can't, wait for it to break, and start to put your money in down here. So this is where you want to be putting your money in if you're getting dividends or distributions from your high yield portfolio. Put them in down here. Right? This is where you want to start building up your portfolio down in here. But we're almost down there. We got one drive down. Look at this drive down. We'll just have to wait and see. We don't know what it's going to do. Probably something like this. Probably make a little bounce. Maybe it'll come back down in here. We can start putting more money down in here. That's probably what it'll do. Probably down in here somewhere. We'll start seeing a bunch of sideways reaccumulation, right? Because that's what the map says. See the map right there. There's the map. There it is. It is probably exactly what's going to happen. We'll come down off this top up in here. We'll come down and make a little thing like that. And that's probably where we're at right now. I'll probably do a little sideways dance right around 38.2 right in there. And then I'll probably make one more little drop down in here. Might not. Might turn around and go back up from there. But my bet is it'll come down and do this one too. And we'll see this thing then turn around out here. That's probably what we'll see. Doesn't mean it's going to. It's just a map, right? Maps try to give us an idea where these things are going. Same thing with NVIDIA. Now, NVIDIA just had great, wonderful earnings, right? Oh, they had great earnings. How come it's coming down? Well, because it's at the top of a 3-drive pattern, top of a 4-drive. Look at this, drive 1, drive 2, kind of a little drive right there. I'd call that 2 drives. Then we got this little sideways thing, and then another drive. And then we got that little 4th drive up in there. Whoa, that's kind of crazy, isn't it? So we're going to come in here and we're going to call this a little head and shoulders formation. This little neckline here, neckline, head and shoulders. We'll probably get a little rally up in here, little right shoulder, and then it'll probably drop again. I think we'll probably get something like this. And we'll probably get a little drop down in here. Probably come down and test this lower region down in here somewhere. Probably get a little box down in here somewhere. I bet you we see prices on NVIDIA down in this region here. Probably down in there. It's a pretty strong stock. I don't know if we'll get a complete full, retracement all the way clear back down into this Fibonacci region here. But we may, but I think we'll at least see it down here at 38.2. Right? 38.2 is our first target. So if it comes down there, we can start adding a little bit back in. You start getting some dividends, and it's at 38.2. It's down in this little box. Throw some dividends back in there. It's okay. This is where you're going to start going through the accumulation stage, right? Down in here, right? Down in here. So we're going to start seeing that happen down in here with NVIDIA. All right, let's go look at Tesla. Tesla, just like a train on rails, just like coming right out. Look at this. Look at this. Right? Look, came right down here. This is the accumulation stage right here. See this right here? This is this right here. Right here. And then it kind of rallied up, kind of made this thing here. Now, this was a little elongated, and that was a little bit of when Elon was doing his little crazy stuff, and everybody was not sure if they wanted to be a part of Elon's world. And then it kind of went through like this and made that little triangle formation, okay? But then it took off and continued along following the map. Not quite like a train on rails, but almost. I mean, it still came in and made that little rally right up through here, and we got this little topping formation now. That's this little section right here, okay? And if you go back in time, the previous one to this was just like it too. You can go back in Tesla and look. It was just followed this map just like that, just one Darvas box after another. But you can see this little section in here. We kind of went sideways through here, and then it took off and it went this up in here. But this topping formation right here is right here. That's this. Now it's coming down. What are we going to expect? Well, we're going to expect it to come down and do this little sideways dance, maybe go back up a little bit, and then it'll flush one more time, maybe down here, half or 50% of the last major move. So if we measure that out, we just come in here from the bottom to the top. And, we're just doing a swag. This is a swag. It's a scientific wild-ass guess. Everything we're doing here is just wild-ass guessing. We don't know, but we're trying to be as scientific about our wild-ass guesses as possible. So at least you're trying, right? I want you to at least try to make some more educated guesses than just throwing your money at the market just because you got some. Oh, I got a dividend today. I guess I'll throw it back in the market. No, just, try. Just try to be a little bit better than just throwing it back in the market. Just try a little bit. It's going to be if you just try a little bit and you're wrong, it's still better than just hucking it back in the market just as if it was a loogie on the wall, right? So we're going to come in here, and this is going to be a little ABC pattern. right? And then we're going to come in here. We're going to anticipate that this is the region right in here where we anticipate the market's going to be. And we're going to look for this market to be nice and big green down in here. And that's where we want to start hucking our logies back against the wall again, down in here. All right. Rather than way up in here where the probabilities are not good. And that's the whole Magnificent Seven. Now, that took us a little bit longer than I wanted to go. We wanted to go look at Bitcoin. Let's pull up Bitcoin for those of you who are waiting. Kendall wants to see a whole bunch of these things. TQQ, SOXE, the SQQ. Now, remember, Ken, when we're doing analysis for these high yield funds, we don't look at the funds themselves. So you don't want to go look at SOXE, for example, or you don't want to go look at TSLY and say, oh, I got to do my Fibonacci projections and my 1, 2, 3s and my ABCs. Oh, why isn't any of this thing working? Why isn't my technical analysis like Land taught me working on these high yield funds? What a piece of shit. The yield that thing Land does, that sucks. I can't do it. Oh, look how awful this market is. I don't want to be in this market. No, we don't. Time out. We don't do technical analysis on the underlying stocks. This is just a bucket of money that's being used to trade options on the underlying stock. And the money comes in and flows in and out of here, It comes in here when they make money on their options. And then when they play a distribution, they pull the money out of here and give it to you in your cash account. So that's not what this is. This is just a cash account for the traders that are trading your money for you on your behalf, and they're trading it on Tesla. So anytime we decide we want to put money into this market, we do it under Tesla. So we go look at Tesla and we say, where is Tesla at in our 3-drive pattern? Where is Tesla at in our Elliott Wave? Where is Tesla at in my setups and my patterns and triggers, right? So we want to look at where Tesla's at over here. And then when we say, well, we're down here in this Fibonacci sweet spot, or there's lots of buying activity down here on the big hedge funds, I want to start buying too. We don't put the money into Tesla. Not that you can't, you certainly can. But then you come over and you put your money into TSLY, irregardless of where TSLY is at. You don't care where TSLY is trading. It's irrelevant. It has nothing to do with technical analysis. This is just a bucket of money. This is just money that's sitting there that they're using to trade Tesla with. And the money comes in and out of this thing, just flows in and out of here. All right. It's just a holding bin. So we don't do any technical analysis on this market. All of our technical analysis is done here. And then we make all of our trading decisions here. And then if you want the high yield fund, you put your money over into the TSLY. That's how you do it. All right. So if you're going to look at Microsoft, you don't go and look at the Microsoft fund. You look at Microsoft here and make all your trading decisions based here, and then you put your money into the Microsoft high yield fund. All right. Let's make that straight. So there's no reason to go and look at some of these high yield funds and see what they're doing on buy. We don't look at those. Now the problem is that you've got some of these funds that are like SOXE, for example, which is it's not a single stock. It's not a single stock ETF. It's a fund. So it actually does have more than one stock in there. And it's harder to kind of say that about these longer term, or these funds that have more stocks in them, because they're made up. SOXE is made up of a whole bunch of stocks. It's not just one. So you kind of have to take that into consideration. And you still kind of want to go and look at the other underlying stocks, but you can kind of look at this one and see where it's, going through the accumulation distribution stages as well to some degree. And it's going to reflect that a little bit. But remember, SOXE is one of the target 12. So SOXE in particular is a target 12, meaning that they're not taking all the money out like they do with a single stock. So like in single stock futures TSLY, they take out every single penny that they possibly can and give it to you as a distribution. That's why it never does have much movement. Now back here, this is when they, the market was tanking and dying. But they kind of got that settled down. And so right here, this is kind of just a pretty typical of what we want these markets to do, which is nothing. We just want them to stay flat. And they're going to take out all the profits along the way. So that market goes up, 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 up. They're taking out the profits all along the way and giving them to you. But you're sitting there stuffing them right back in, building your upside down pyramid. And so don't do your technical analysis on these markets. So we want to really do them on these underlying markets like this. All right. So that's how we really want to do this. And so let's go. We kind of really run out of time. So we got to kind of call it quits. But we're going to go over here. I had a whole nother blue chips list that I wanted to go through and look at. We'll go. That one didn't load very good. Let's go look at Costco. So this is Costco. And you can see it's coming all the way down. It's really kind of busted through drive 1, drive 2. It kind of made a little retracement, then got one, drive 2, drive 3 again. So we're really at the bottom of a, it kind of really is having a hard time. I really don't like it. It's down here kind of testing these lows. But that's kind of where you want to start looking for the opportunity to get into the market. So there, I'll show you a little trick. What you do is you come in here and you say, okay, we're going to come in and we're going to draw our little head and shoulders formation, right? So this is the low. So we're going to say here, 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 here. And so you're saying, okay, that's our bottom. But then the market came down and broke the low right here. And it started a new bottom. So what you have to do is you say, okay, well, we have to adjust with the market. This is not the bottom. We got a new bottom down here. So we're going to move our head and shoulders. We have to move the whole system over like this. All right. So now we take this one. This now becomes the left shoulder. This becomes a neckline. This becomes the head down here. And actually, this would probably be up here like this, wouldn't it? Like this. So this becomes your neckline, and this becomes your right shoulder down in here. And then you're like, oh, wait a second. It just broke again. This is no longer than, and you'll notice this just becomes a natural trend line across the top of the trend. So you're now like, oh, now we got a new low. So this is no longer the head. So then you have to just take this whole thing and move it over one more time. And so you just adjust it like that. So every time you say, well, it's hard to do this on the fly. Yeah, it is. If we're easy, everybody would do it, right? So we kind of have to adjust with the market as markets keep making these, and these are the patterns that we're going to look for. And we want to kind of see this thing happen like this. Where's the bottom going to be? Is this going to be the bottom this time? This one wasn't, this one wasn't, this one wasn't. So we have to keep adjusting. And then that's why we don't want to take the first A1. Remember, we don't ever want to take the first A1 drive up, because it oftentimes, it fails. There's your first A. There's your first A drive. There's your first A drive. See, it failed. It failed. It failed. And it failed here, and it might fail here. We don't know. It might come down one more time. That's why we don't take the first one. Okay. We like to take the A2s. Okay, or the B1s. We like A2s, B1s. We don't like to get in on an A3, because A3 is probably going to flush back down and half or 50% of that move. And then that's where we get our B1, right? So then we look for the B1 after the A3. So that's what we're doing. We're coming down here and looking just for opportunities. We have to keep reading the market. And each time it doesn't do what we want, we have to readjust to the market and see, well, if this is the next pattern, and then maybe this is where it'll take off and go up and we can get in. But we have to wait and see. And actually, we don't want to get on the first one, right? We want to wait for the first pullback, and then we get in on the second one. So that's what we do. So that's Costco. Let's go down and look at JP Morgan really fast. JP Morgan, I'm just going to draw the same. Look at this thing, crazy. Drive 1, drive 2. You'd almost call this drive 3, and then this was the top, and then it just made another little push up here. Crazy, crazy. So we have almost like a little Darvas box right here. And then there's our 3 drive pattern, and then it made one of these little wedge patterns and went into a reaccumulation stage is what we call that. All right. And then it started going up again. It didn't make its little retracement and come back down, a little ABC like we thought. Well, wow, that's a strong market. So it broke out and started making another little ABC pattern up. But once it starts to do that, I start getting really scared up here, because I don't, I think it's going to eventually come back down. It's got to test this other Darvas box. So that's another little Darvas box. You can see how short and flat it is and stinky. So I think we got to get some sort of a push back down. Maybe we take a Fibonacci all the way from the low to the high and anticipate eventually, maybe a move down into this region here. That might be kind of a much to ask. But if we do a Fibonacci from here to here, well, it's there now. It's right there in that Fibonacci sweet spot right there right now. I think we're going to watch this and see, but this looks like to me, make a little Fibonacci topping formation up here, a nice little double top. We might see it down here, 130.9, maybe down testing some of these regions here. It's just a really strong market right now, but I think we need to get some sort of a pullback and an opportunity to buy low. So I think we're going to be watching right down in here. We'll be watching for some green bars down in here on JP Morgan Chase. All right, let's go look at Eli Lilly. Wow, look at this market. Holy cow. That's crazy, isn't it? Look at this. Drive 1, drive 2. We got this little sideways drive 3 at the bottom. We ended up with kind of this ugly little downtrend. But then we got drive 1, drive 2, drive 3. You guys want to buy right here? You want to start stuffing money into that market right there? Why not? Well, because the odds are really low that thing's going to continue up. We'll probably get some sort of a little ABC pattern, right? Even if it wants to make a fourth drive, it's a really strong market. It's going to probably still come back, maybe make a little You know, even if it does something like this, probably what it's going to do. But even the little bow tie, see this little bow tie? See this area of support right here, resist right here. See this resistance right here? It became support. See, so it comes down. So that's your little Fibonacci bow tie. Come down here, way up there. Probably come back down and test that previous low right there. And then that would be a nice place. Maybe we'll see if there's a big green zone down in here. See if there's some green. Maybe buy up in here. But of course, I think it'd probably make a little 3-drive ABC pattern, probably come back down in here again. So just, you know, speculating, just throwing this against the wall and saying, I don't know where it's at, but I don't want to be a buyer right there. I can tell you that. Don't want to start throwing money at that one. I know a lot of people who do. They'll look at that and say, look how great Eli Lilly's doing. Oh my gosh, I got to have me some of that. But of course, this could be the accumulation stage right in here too, right? This could be the entire accumulation, and this could be actually drive one. Right? This could be drive one. It could come in, make it drive 2, drive 3. We don't know, you know, hindsight will tell us, but I don't certainly want to buy high up here. I'm not looking to get into the market up there. I want to wait for it to pull back and get in on the little dip. So wait for it to pull back in here. Maybe test this previous high. It might not come all the way back down to there. Might be too strong. Come back down in here somewhere. And this mare would be a buyer down in here. Just watch for that first green candle to make a new high, turn around, start going back up. And then that's where we could be a buyer. Maybe look for it to continue higher. But that looks like a beautiful accumulation stage for about 6 months. And man, that thing rocketed out of there like a spaceship, like an Elon rocket. Look at this one. Woo, Oracle. Oracle was the big baby, right? For a long time. Drive 1, drive 2, drive 3, counter trend. Whoa, 4th drive. That's just nuts. But then it's flushing like a toilet right now, coming back down and testing this previous low right down in here, right? So where's it at right now? Well, it's definitely back down into a zone where you can start to maybe throwing a few shekels in there, but it's kind of still on a flush down. That little blue light hasn't intercepted yet, so we'll wait for that blue light to intercept down in here somewhere. We'll have that natural trend line, but we got a nice little ABC pattern up in here. So we go A, B, C, and look at that. That thing's all the way down here, testing 130.9. So you can see this little Fibonacci ruler is kind of telling you, kind of giving you a little idea of where this market goes. All the way down here, 130.9 headed towards 160.8. If you do a complete Fibonacci sweep from all the way to the bottom to the top, well, that Fibonacci cone of delta cone of probability is right in here. It's at the bottom of that right now. That's crazy. This is a great company. This is the company that builds all of the data centers for all of the AI systems. All right. So this is everybody saying this is this is AI bubble popping right now. No, it's not. This is profit taking. These guys made so much money riding this thing up. Now they're just taking some profits. They want to do it again. They want to get that thing down there, reaccumulate a whole bunch of shares because they sold out all up here, right? They don't have anything left. So they don't want the market to go up because they don't have any shares. They bought all their shares down here and they sold them all out. Sell, 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 sell. Oh, buy some more. Sell, sell, sell up in here. They're out. They don't have any shares left. So they want the market to come back down so that they can buy some more shares. That's what this is all about, right? That's what this thing's all about. They're out of shares right here. This is what brings the market down. They go through this reaccumulation stage so they can buy some more. So that's where we're headed into right now. We're going to start, you watch. Mark my words. This thing's going to start going sideways through here. And this is where the big institutions will start buying, buying, buying. Buying, 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 all right? And they're going to do some crazy manipulation because remember, there's something called the float. There's not very many shares available to buy, but they want a whole bunch of shares. So they're going to do everything they can to get you to sell them your shares. If you own shares here, they want you to sell out. So they're going to play games down in here to try and get you to sell all your shares to them so that they can next time this market, because this is a great company. All right. They're doing really well and it'll go up again. I'm not going to guarantee anything, but I'm pretty confident this market's going to go up again. They just need to get a hold of a whole bunch more shares so they can make some money. All right. So that's what it's doing. Same thing with here. Look at this nice, big, beautiful trend line on Wells Fargo all the way up. They're getting ready to dump that thing. It's going to come down. You watch, mark my words. They're getting a little ABC top up in here. You can see them wanting to do it right now. All right. They tried to do it there, but it went up a little higher. So now they got to do another one. Where's this going to come? Well, it could come down and test this low right down in here. But they're going to get a little ABC pattern up in here. How low that's going to go, nobody knows. We can draw our Fibonacci ruler in there from the low here to the high there. This is right dead center of the Fibonacci sweet spot right now. Okay. So this may be right in here. We'll start getting a little bit of a sideways move and then a little rally and then probably another drop. Come down and test this low. They want to buy some more shares. They don't have any more. They're out. They sold them all out. Now they want to get the market to come down in here so they can buy up some more shares. They want to get you to sell them to them. So they'll buy some more shares down in here and they'll do tricks to try and get you to sell your shares out. That's what they do. So that's what we're looking for. Walmart didn't load, so I'm going to just forget that one in the interest of time. We could go reload it, but it didn't load. So, all right, guys, that's that one. We were going to look at Bitcoin. Let's go look at B. Let's go look at BTE. BD? Is it BD? Is that Bitcoin? Yeah, that's Bitcoin. ProShares Bitcoin. Look at it go. Wow. We had 3 drive pattern, drive 1, counter trend, drive 2, counter trend, drive 3. We hit that top. Now it's coming down, drive 1, counter trend, drive 2, counter trend, drive 3. Man, we're coming right back down all the way to the bottom. But well, that's kind of a nice little 3 drive pattern in there. We've got this area right down in here where it's headed to. This is the area of support right down in here, right? This was the previous accumulation. So probably right down in here, we might see this thing slow down right in here. And maybe we'll start going through a new reaccumulation. And that's what we're seeing here on Bitcoin. You know, buy low, sell high. But this market did come down a lot further than we anticipated. We anticipated that it was going to only come down to this region here, right? And it busted through that like a train on rails. Like there was no tomorrow, and it busted through that. Now it's coming down all the way down into this next region. So that's kind of what we're looking at on Bitcoin. Doesn't mean we can't go into a bear trend. We certainly can, right? Because 1, 2, 3, this would be our first Darvas box right in here. So that'd be our first Darvas box ending right in there. And now it's busting out the bottom. So it could go into a downtrend Darvas box. So this would be our first drive down, a little rally, and then we could just get a 3 drive rally off the bottom there. But this is kind of, you know, we'd want to see it actually get a little reaccumulation in there. Probably down in here, and to get that thing to come back up. But this could easily, oh, come on, man, get your right tool. So this could easily come down. Maybe we could get a little thing going like this, but this could easily be a downtrend Darvas box. Might get another Darvas box down here. And that's sad to say because, I mean, I had Bitcoin, but I sold it all out up in here, but I still have some of the ETFs that are paying out. And I've been looking at the numbers on them. And because they keep coming down here, it keeps pushing my break even out. It's like, oh, you were going to break even in 3 months. Now it's going to be 4 months before you break even. So it pushed my break even out a whole month based on the dividends coming in and how far down the NAV went. So if you're in the same situation as me, we're just sitting here watching this thing flush out. So our yield is going to take longer to pay for our growth, right? Our growth is going down, 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 which means our yield has to pay for it. And it's just going to take longer for those things to pay off. I was to the point where I was about 3 months before I was going to get paid off on my Misty, 3 months away from having to be a cash cow. Now it's pushed it all the way out to 4 months. And probably if it keeps going down, be pushed it out to 5 months. It'd take me 5 more months to get my dividends to cover enough to cover up the fall on this thing. We just need it to stop falling. We don't care if it goes up. We just don't want it to stop to fall. Just go sideways. That's perfectly fine with us because then our dividends can start paying and helping our yield can pay off some of that lost NAV. And then it'll catch up to it 2, 3, 4 months out. And then maybe we can start getting some growth again and we can get both yield and NAV again. So that's what I'm looking for. But, you know, if you do your math and you look at your spreadsheet, all it's really doing is it's just pushing out how long it's going to take before you get back to a cash cow. All right, guys, that's it. That's the name of the game. Hopefully I just kind of really doing high level stuff here. I wasn't going through and doing this is an A1, a B1, a C1. This is a A2, C2, C3. This is a, you know, A1, A2, A3, B1, B2, B3, C1, C2, C3. That's all in the manual, and you can go look at that. But really, I'm just kind of doing high level stuff here. And this is what we kind of look at when we're looking at these markets on a longer term basis, trying to anticipate where we're going to put our redistributions and where these markets are headed and how we read these charts from a kind of a high level, again, not getting real detailed into it with a lot of indicators and everything, but just kind of looking at it from the recurring price patterns and looking at it from the accumulation distribution model. But you can see how the market just has a tendency to repeat itself over and over and over and over again. And we went through some of the biggest, most popular stocks in the world, and they're, you know, those patterns are there every single time, one after another after another. So just keep that in mind. Do it yourself. Go back, look at charts, try and read it. Just do the best you can. I know that this is a lot of information to be kind of assimilating, and it'll come to you relatively easy after a while. You just keep watching me do it over and over. And that's why I come and do these labs, because we talk about them in class, and sometimes in class it's just like, wow. But then you come and look at it in practice and you're like, oh, that's not that hard. Markets go up and down, and that's what they do. And we're just going to count them and kind of look at what the probabilities are that they're making drives here and there, and kind of try and push out into the future and see where they're going to be. And it's the best. We just do the best we can. All right. It's the best we can do. Just do the best we can. If we screw it up a little bit, so what? We just don't ever go all in. Just don't ever go all in and throw all your money in. I'm going to throw everything. I got to back up the barn and the house and sell the kids and everything. We never do that. All right. We just put a little bit in here, put a little bit in there, put a little bit in here. And if we're wrong, it's all right. We'll just kind of make up for it in the future with a little bit more here, a little bit more there. We just do the best we can. All right. Doing a little bit best you can is better than doing nothing at all. And that's all my point is. Just try to do a little bit best you can. It's better than not doing anything at all. And that's the name of the game. All right, guys, that's the carnival game today. We're going to let you go, and we will catch you again. If you haven't picked up Pitt News Magazine, why not?
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, guys, that's all I got for you today. We will see you bright and early. Wait, what's today? Today is Thursday afternoon. So we will see you tomorrow. Should we do another lab tomorrow morning? That's the question, because we got class tomorrow night. That would be 2 classes in one day, and it's Friday. So let's just relax. Don't get all stressed out. Just take what we've given you here today. Watch the markets tomorrow. We'll not do a lab tomorrow. Let's just do class tomorrow night, and then we'll do a lab again on Monday morning. How's that? Next week, there's no class because it's Thanksgiving week, so the school is out. So we'll do a couple of labs next week, maybe Monday. Maybe we'll do, well, we don't want to do it on Thursday. Wednesday's probably a busy day. Maybe we'll do one Monday and Tuesday. How about that? We'll do labs Monday and Tuesday next week, and then we'll have the rest of the week off. Tomorrow, we got class tomorrow night at the university, and then we'll follow up with that class on Monday for the lab, and Tuesday again for the lab, and we'll probably do some day trading. We got to do day trading. Maybe on Tuesday, we'll do some day trading. All right, as we go into the holidays, and we'll do a little day trading on Tuesday. So we'll apply some of these techniques to our day trading, but we'll also maybe look at some of the Yield Max funds and some of the Granite Shares funds, and we'll go through and kind of do a little bit of analysis and see where we want to look at those. We kind of covered a lot of those today, but there's more to go, and there's lots more we can always do. So we will see you bright and early Monday morning. But for those of you who are coming to the university, we'll see you at the university tomorrow evening, 6 o'clock. Don't be late. All right, because we like to start right on time. And don't quit on me. Don't you dare quit because, oh, it's getting too hard. I can't do this. Don't you dare quit. You come and stick with it. I'm going to be here for you, so I need you to be here for me. All right? All right, we'll see you guys tomorrow night. Have a good day.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.